Hello and welcome everybody to another video of Navigate AIF. In this video, we will be discussing the recent SEBI consultation paper on co-investments by AIFs. To start off, I want to first discuss the concept of co-investment. What exactly is co-investment and what is the current regulatory framework governing co-investments in India? So let's get started. Co-investment means investment made by a manager or sponsor or investor of category 1 and 2 AIFs in investee companies where such AIFs make investments. So co-investment is when the manager, sponsor or an investor of the AIF makes investment in companies where the AIF has already made investment or where the AIF is also making an investment, provided that co-investment by investors of AIFs is made through a co-investment portfolio manager as specified under the SEBI Portfolio Managers Regulations 2020. So currently, if any investment manager wants to offer co-investment, then they need to get a license and they need to be registered as a co-investment portfolio manager under the SEBI PMS regulations, that is the SEBI Portfolio Managers Regulations 2020. An investor gets the right to directly invest in an investee company in parallel to the investment being made by the AIF. For this purpose, the investor negotiates the special right of co-investment with the AIF at the time of subscription to the fund. The terms of co-investment in an investee company by a manager or sponsor or co-investor shall not be more favorable than the terms of investment of the AIF. The terms of exit from the co-investment in an investee company, including the timing of exit, shall be identical to the terms applicable to that of the exit of the AIF. So basically, what the regulatory framework currently specifies is that your entry, exit, price, timing, everything that you do with respect to the investment made in a particular investee company has to be the same for co-investor and for the AIF. So it said that they are supposed to be co-terminus. This is the current regulatory framework. Now let's see what SEBI is proposing in its recent consultation paper. So this is the SEBI consultation paper to offer flexibility to AIFs, offering co-investment opportunity to investors within the AIF structure. The objective is to enable AIFs to offer co-investment opportunities in unlisted securities through co-investment vehicle. So in this structure we will be discussing, the proposed consultation paper actually provides for a co-investment vehicle structure. It's a very unique structure in India, and I think that this structure holds possibility for managers to really increase their AUM and also grow their business to the next level, and we will discuss how they can do that. It also wants to remove the prohibition on investment managers to provide advisory services in listed securities. So let's see what this means. First, it's giving a background of co-investment. So this is what we discussed, the meaning of co-investment, and also who can you offer co-investment to. So co-investment opportunities are offered to investors who meet certain objective criteria. So manager can choose the objective criteria. Some managers say that it may be on the size of the investor, or they may say the value, the strategic value of an investor, etc. Manager can decide certain criteria basis which investors will be eligible to get access to co-investment rights. Now, SEBI had received a representation from the AIF industry in 2021 requesting to allow co-investment facility within the AIF structure by issuing a separate class of units to co-investors, highlighting the following constraints. So the industry actually wanted to offer co-investment by way of issuing a separate class of units to the co-investors. Currently, we discuss a structure. Currently, the structure is that you have to do a co-investment PMS. So industry actually wanted that instead of co-investment PMS, we want to issue a separate class of units. But they highlighted that these are the constraints that we are facing currently. That is why we want a separate class of units. So what are the constraints they were facing? Subsequent to the notification of the PMS Regulations 2020, so on the January 16, 2020 notification, after this, discretionary portfolio managers cannot invest funds of their clients in unlisted securities, and the portfolio managers offering non-discretionary or advisory services can invest or advise in unlisted securities only up to 25% of the assets under management of the clients. So as co-investment is generally made in unlisted securities, the portfolio management route earlier followed by managers became restrictive for such co-investment. So managers couldn't become only a portfolio manager to offer co-investment because there were these regulatory constraints. They couldn't invest in unlisted securities if they were discretionary, and non-discretionary they could only invest 25% in unlisted securities. So they suggested that why don't we do separate class of units. Further, as per PMS regulations, the clients have an option for early termination of the portfolio management contract or agreement, as well as for early withdrawal of funds and securities, thereby allowing the investor to exit from an investment before the expiry of the tenure of the contract. So a PMS is very different from a fund. In a close-ended AIF, you would have a certain time. You can only enter and exit with other investors of the fund because everybody's money is pooled together. PMS doesn't have pooling of money. Everybody's assets are held in their individual bank accounts, individual demat accounts. So the assets are held in the name of the investor, not in the name of the fund. So if the investor chooses tomorrow to end the portfolio management agreement, they can do that, and the PMS regulations also provide for that. But that is difficult if you want to do co-investment, because if you allow the investors to terminate early, then they may choose that, we make the investment, now we'll terminate the portfolio management agreement, and now we'll exit whenever we want. So that could lead to conflict in the investor's interest, so interest of the co-investor and the interest of the fund. You want that the interest of the fund and the co-investor should stay the same, so that you cannot offer a better deal to the co-investors than what is offered to the fund. This is to prevent conflict of interest between the manager advising the co-investor and the manager managing the funds of the AIF. That is why. So, manager offering co-investment is expected to align the interests of co-investors with those of the AIF, so that the interests of the investors of the AIF are not adversely affected by the co-investment. Just like I explained, you don't want that the interests of the investors of the AIF are adversely affected by the co-investment. If the co-investor makes an early exit or divestment from the investment, such decision may not align the interests of the investors of the AIF with that of the co-investor. This may adversely affect the interests of the investors of the AIF. So this structure also has its issues. If you do this, then the interests will not align. Let's see the third structure that they said. Apart from portfolio management route, the manager can advise co-investment through investment advisory route. However, the same does not enable the manager to maintain alignment of interest of the investor of the AIF with the co-investor, since the co-investor has a discretion to take investment management decisions, including exit from investment, and the manager only provides advice to the co-investor. So now, there is a difference in portfolio management route and an investment advisory route. In portfolio management route, you can have two types, so discretionary and non-discretionary. In a discretionary portfolio management route, the manager will be taking all the decisions on behalf of the investor also. So they would have like a power of attorney on the assets and on the money that the investor has put with the manager. The manager will be making all the decisions. The manager will decide when to enter, exit, whatever. In non-discretionary, the manager will take the decision, but after consent of the investors. So investor has to sign off on every investment. In investment advisory, the manager has to only give investment advice. Say you are investing in company A, you can tell the investor, okay, I have an option to invest in company A, but making that investment, all the negotiations of that investment, everything will be done by the investor only. So again, it's impossible to do a co-terminus with the AIF. That is, you cannot have entry, exit, pricing, etc. same with the AIF and this investment advisory client, because the investment advisory client will be taking their own decision. That is why this also doesn't work, and it doesn't align the interests of the investors of the AIF with that of the co-investor. So in view of the above, the AIF industry represented to allow co-investment within the AIF structure itself by issuing a separate class of units. So if they do separate class of units, then they could maintain alignment of interests of the co-investors with the interests of the investors of the AIF. Next, taking into account the recommendations of the Alternative Investment Policy Advisory Committee, called IPAC, and internal deliberations, the proposal to allow co-investment within the AIF structure by issuing separate class of units was not acceded to. SEBI didn't accept that proposal because of two reasons. First, AIF is a pooled investment vehicle. In an AIF, all the money that is invested in the AIF is pooled of everybody. You don't have separate bank accounts or separate demat accounts for each investor. All the money is in one account, managed by the custodian, and in the name of the fund. So the fund will be investing this, and everything is pooled together. So if you allow co-investment where the rights of certain investors are separate, then that wouldn't be pooling. So where the rights of certain investors in investments of and distributions of the returns of the scheme are pro rata to their commitment in the scheme. So the rights in the AIF have to be pro rata to the commitment, and distributions and rights in investment also have to be pro rata. So this can't be followed if you have a co-investment structure where a separate class of units is only issued to certain investors, and they have additional benefits in certain investments because their exposure is more to those investments. That is one reason why SEBI didn't allow it. Second reason is pooling of funds is an essential characteristic of an AIF, which provides the AIF a distinct identity from its investors and hence should not be compromised. So again, they want to maintain pooling, and everybody's investing in the same assets. However, currently also the framework that is allowed by AIFs allows for uh, differential exposure to certain investments, because some investors can be excused or excluded from certain investments. Say you are an investor with an internal policy. For example, say I am Jane and I have a policy that I will not invest in companies that make meat products or um, something like that. So then I can submit that policy to the AIF, and the manager can excuse me from such investments. So in that also, pooling would not be technically followed because those investors will be excused from that particular investment. But regardless, SEBI didn't accept this proposal, and it was also viewed that to facilitate the managers to manage co-investment of their investors in unlisted securities outside the AIF framework, amendment to the PMS regulations to enable co-investment through portfolio management route merits consideration. Accordingly, AIF and PMS regulations are amended in December 2021 to facilitate the co-investments, which is applicable presently. This is the co-investment PMS structure that we just discussed, that you have to get a license under the portfolio managers regulations, and SEBI did not allow these structures that are provided here. So, what is the thing now? What are the issues in the current framework that SEBI is identifying, and why has SEBI now come up with this new co-investment vehicle structure? So, SEBI actually set up a working group to review compliance requirements under the AIF regulations and provide recommendations with the objective to simplify AIF regulations, to provide ease of doing business, and to reduce cost of compliance to the AIF industry. This working group is called this now. In respect of the extent, so the current co-investment framework, the working group highlighted the following issues in the current regulatory regime for co-investments. So what are the issues they are identifying? First issue is that seeking an additional SEBI registration as a portfolio manager is an added cost and also poses hindrance in offering co-investment right to investors due to the conditionality contained in the PMS regulations. So there's added compliance and added cost. That is a big issue, because say you are seeking registration as a co-investment portfolio manager under the PMS regulations. Firstly, when making the application, you have to pay 1 lakh rupees plus GST, which is a non-refundable fee to make the application. And after you get registration, you are required to pay 10 lakh rupees plus GST again to get the registration. Further, after every 3 years, you have to pay 5 lakh rupees to renew your registration. So it's a very expensive registration to have, and that is one added cost that they are looking at. Further, it also affects the competitiveness of domestic investment managers, as their competitors, which are global PE funds scouting India deals, are not subject to any constraints on co-investments and can easily acquire large stakes in Indian companies or participate in large ticket size deals. So say Mauritius funds or Singapore funds working actively in India, they don't have this co-investment restriction. They don't need to be a co-investment portfolio manager there. So they can come in to Indian companies and get large stakes. The only difference would be, for foreign fund or a global PE fund invests in India, they would have to comply with FEMA. But say investment is FEMA neutral, like it's equal for a foreign investor and a domestic investor, 100% automatic route FDI type of investment, then the global PE funds would have an upper hand, because they would be able to offer easier compliance to their investors, as they don't have to do the CPMS, etc. Compliance and cost. That is point one. One reason why they want to change the regime. Second, portfolio companies are sensitive to both the investor profile and the number of investors directly participating on the cap table. Investors, on the other hand, seek such participation without the burden of undertaking compliances arising out of such investment. So point one is, cap table actually means the number of investors in the portfolio company. So a portfolio company in India, if it's registered as a private limited, can have up to 200 members or 200 shareholders. Now they are sensitive to who is actually a shareholder in my company. They don't want to have too many investors. Say they get 100 investors, it may cause more trouble for them. So they may not all companies would want to have a lot of investors on their cap table, and they also want to look at who is exactly the investor who's participating, what is their profile, what is their background, etc. Further, because investors are directly on the cap table, they may also have burden of undertaking certain compliances because of making the investment. So that is point two. These compliances could be like entering into the SHA, SPA when they're acquiring the company. There would be some ROC filings also, but I think the company would undertake that, not the investor. Next, the documentation becomes cumbersome with multiple co-investors and causes delay in timely closing of transactions, and in some instances loss of opportunity to participate due to delays involved in each co-investor, as each co-investor will follow its own process of closure of documentation. So in the current co-investment PMS framework, because I said it's a PMS, So each investor has its own demat account and they're investing in securities in their own name. So they have to sign everything and they have to approve or do the required documentation. Now, if there are 10 co-investors in a deal, then all 10 of them have to do the documentation, which could cause delay and was appearing to be cumbersome. So industry has given this feedback to SEBI that this is causing a lot of time and sometimes even loss of opportunity to participate in deals. Next, the current regime restricts advising on listed securities in the co-investment context or to advise other funds that are operating alongside the AIF on a parallel investment model basis. So let's see what both of these means. First, under the current regime, AIFs cannot give investment advice on listed investments that the AIF has made. They can only offer co-investment on unlisted investments that the AIFs have made. So that is point one, which is a problem. Second, what is a parallel investment model? A parallel model would be when a fund manager can choose to launch two schemes. The second scheme, so both the schemes would be parallel to each other. They may be managed by the same manager or associates of the manager, and they would be investing in the same company. So this kind of a parallel fund also wouldn't work in a co-investment PMS because the AIF couldn't become a client of a PMS. So I think because of that, they are saying that the parallel investment model is causing issues. So the working group has recommended allowing managers of AIFs to advise investors on listed securities in the co-investment context. So first, permit investment advisory in listed securities. That is the ask. And second, they also want to permit advising other funds that are operating alongside the main AIF on a parallel investment model basis. So manager should be allowed to advise other funds that are investing parallelly with them. And I think this is to allow them without them becoming an investor in the AIF. Currently, let's say you are a fund that wants to parallelly invest with an AIF. How can you do this? So then this fund A, which is wanting to invest parallelly with fund B, fund A would have to become an investor in fund B, and then fund B would have to offer co-investment rights to fund A, and then fund A would do it. Fund B, the manager of fund B can't directly give investment advice and allow them to parallelly invest. And here I think the meaning is that they want to allow co-investment in parallel funds directly without fund A becoming an investor in fund B. So that's also an interesting request, and it would definitely be helpful for AIFs and allow a lot of AIFs to parallelly invest, which would cause bigger rounds also. So that's very good. Extend framework under the PMS regulations. The current framework under the PMS regulations requires the terms of exit and timing of exit to be identical to such terms applicable to exit of the main fund. So like I said, it has to be co-terminus. The terms of exit of the co-investor have to be the same as the terms of exit of the main AIF. However, each co-investor may have its own internal guidelines on exit timeline and thus prefers to have the right to choose not to exit. So if some co-investor doesn't want to exit, then they want to give them flexibility. This could cause conflict issues because it's possible that the AIF may exit and the co-investor doesn't exit, and hence you can see the differential treatment, not differential treatment, but it's like a conflict where the co-investor is getting a better deal and they stayed longer. So let's see what the industry's feedback is on this and whether SEBI actually allows this, because this is the main reason why you can see that the co-investment model currently is avoiding conflicts, and if co-investors can choose to exit at their own time, then that remains to be seen how they are avoiding conflict in that situation. The current framework has an expansive definition of co-investment that also potentially captures situations where an investor of the AIF is directly approached by the portfolio company or the manager is not charging any fees or economics for its specific services. So because co-investment is so broad, it covers everything. Even when an investor is directly approached by a portfolio company or where the manager is not actually charging fees for certain advisory services. Further, as per the current regulatory framework or existing regulatory framework, co-investment services can be provided only to investors of such funds where the sponsor is the same and it is being managed by the co-investment portfolio manager. So you cannot give co-investment services to other funds where sponsor is not same and manager is not same. Sponsor has to be same and the fund has to be managed by the co-investment portfolio manager only. So this is important. This impedes the ability of the investment managers to connect investors with appropriate investment opportunity. These are the 6 issues that they have identified, and this is why they want to change the current regulatory framework. Let's see what the recommendations from the working group are. So the working group has actually come with a nice new innovative approach. They are saying completely scrap the current framework and let's allow co-investments through PMS regulations with an alternative route through the AIF regulations. So they are saying let the current one be, so allow co-investments through PMS regulation and also allow through AIF regulations. So they are actually comparing three models. They're saying there can be three models of co-investment which we can choose from and decide what we want to go with. Option 1 is a current framework of making parallel investments directly by the investor into the portfolio company through the PMS route. In Model A, the investment manager has to obtain a co-investment PMS license. What is Model B? Issuance of separate class of units with the fund to track co-investment. This is what we discussed at the start. If you issue separate class of units, and SEBI had in 2020-21 rejected this structure, so they're saying, okay, this is also an option. We should consider Model B. And Model C is creation of a separate co-investment vehicle tagged to a fund to enable co-investments. This is Model C. So these three models they have come up with. And the co-investment, the working group is actually adopting Model C. They're saying let's go with a separate co-investment vehicle and let's see the reasons for that. First, they've outlined the framework. How will this co-investment vehicle model work? So first, co-investment vehicle to be allowed to be registered as a category 1 or 2 AIF, that is the same category as a main AIF registered. So they are saying we'll have a separate vehicle which is itself registered as an AIF. That is part 1. Second, a shelf PPM of the co-investment vehicle to be annexed to the PPM of the main AIF at the time of seeking registration of the main AIF. So the shelf PPM of the co-investment vehicle will set out the details like what principles or parameters on which investors of the main AIF will be offered co-investment rights. That could be, for example, on the basis of quantum of capital commitment. There would be a co-investment policy. So the co-investment policy of the investment manager to be made available for inspection by prospective investors prior to onboarding in the main AIF. And last, only accredited investors will be offered co-investment opportunities. So this is very surprising. I don't know why they only want to offer it to accredited investors. So first, for those who don't know, what are accredited investors? Accredited investors are investors who get an accreditation certificate from SEBI. You can get this certificate if you meet certain net worth criteria. What are the net worth criteria? If you're an individual HUF, family trust, then the criteria is that you have to have an annual income of 2 crores or a net worth of 7.5 crores, out of which not less than half should be in the form of financial assets. And if you're clubbing both, then you should have a net worth, you should have an annual income of 1 crore and net worth of 5 crore, out of which 5 crores out of the net worth of 5 crore, half should be in the form of financial assets. If you're a body corporate or a trust other than family trust, then you need to have a net worth of 50 crores. So if you have this, then you're an accredited investor, and there is a compliance with this because you have to go and get this accreditation certificate. So they want to allow this only to accredited investors. I don't know why they have not given a justification also in this consultation paper. I think we should allow co-investment to all investors regardless of whether they're accredited or not, because they're anyways signing on to this PPM. They know what they're getting into. You don't need accreditation additionally to say that you are then eligible, or you are in some way then more eligible to get co-investment rights. A shelf PPM, attaching a shelf PPM also, SEBI needs to then discuss if this shelf PPM will be in the same template as a CAT 1 and 2 AIF PPM, or will it be like a disclosure document of PMS. What exactly needs to be disclosed in the shelf PPM is something we need to know. And co-investment policy is an additional compliance requirement that the manager would have to do then, and they would have to make this policy regularly updated and also make it available for investors prior to onboarding. So they have to change their onboarding module and make sure that the co-investment policy is offered to investors at that time. Third thing that they are suggesting in the framework is the investment manager shall seek registration of the co-investment vehicle at the time of the first co-investment deal by filing the shelf PPM with SEBI, and the same shall be deemed approved if no queries from SEBI within 30 days of the filing. So when they file this PPM, if SEBI doesn't give a query in 30 days, just approve it. This is good. This is a green channel. This is helpful. However, I really doubt SEBI will not make a query in 30 days. Generally, SEBI officers would send you an email with some basic queries always within 30 days, just to make sure that they don't miss anything. Co-investment vehicle shall be given a separate registration number so as to ensure separate PAN to be obtained for tax purposes. The good thing is that they are also suggesting that it will be registered as a CAT 1 and 2 AIF. So from a tax perspective, if the co-investment vehicle has a separate PAN, that would give the co-investment vehicle also a pass-through structure, which is helpful. Category 1 and 2 AIFs have pass-through structure, which basically says that there's no tax paid at the fund level for any income except business income. Only in business income you'll pay tax at fund level. All other income will be passed through. You will just, as a manager, have to withhold certain tax. So for resident Indians, for example, it's 10%. You have to withhold that, and rest income you give it to the investors, and then the investors will pay tax themselves. So getting a separate PAN would allow the fund to withhold the tax and do the necessary legal tax compliances there. Next, the tenure of the co-investment vehicle to be co-terminus with the main AIF. So tenure of the co-investment vehicle and main AIF will be the same, which is also helpful because if you are making, say you have a 10-year fund, in the third year you make a deal in which you are getting a co-investor, then you would want the co-investor to exit with the fund. So the tenure of the co-investment vehicle should be the same to allow for co-terminus exits. Quarterly filing of the co-investment vehicle shall be made as per the extant format subject to exemptions covered, so comfort. So I think they want to have a quarterly activity report type structure for co-investment vehicle also, and they'll see if they exempt them from it or they make them do this quarterly activity filing. I don't really see the point of doing a quarterly activity filing for co-investment vehicle because it's just one investment. If they're doing only one investment, actually, if they're doing more investments in the co-investment vehicle, maybe SEBI can have it, but otherwise, at the time of making investment, SEBI can have a filing like a term sheet with angel funds. That could also be a good way to reduce compliance burdens on fund and not make them do quarterly filing every quarter. Co-investment vehicles to be exempted from the following requirements under the AIF regulations. So they want to exempt co-investment vehicles from 4 requirements. Diversification norms. So CAT 1 and 2 AIFs have a diversification restriction that they can only invest up to 25% of their investable funds in one company. Here they are saying co-investment vehicle can do 100% in one company, which is fair. You may not want to co-invest in every company. It's a fair ask, and they're suggesting exemption from this. Point 2, manager should be permitted to set up a single co-investment vehicle for all co-investments in relation to the main AIF. So one vehicle, say 10 people are choosing to do co-investment, all the 10 can be part of the co-investment vehicle, and then all investments are through that. The challenge there is, what if say you have investor A and B, both want to do co-investment, but both want to do co-investment in different companies. How are you solving that then? I would think in that then you would have to have a separate co-investment vehicle. Otherwise, you'll have to do classes of units within the co-investment vehicle and then offer and do separate investment for each class, which I don't think would be permitted. I think SEBI's intention is that they want to have the co-investment vehicle analogous to an AIF. So it should work like an AIF, so you can't have separate class for separate investments. I would think then if you're having investors who are doing different investments or investments in different investee companies, then you would have to launch a separate co-investment vehicle. But everybody is same in the same investee company. People have agreed to do same investors have agreed to do co-investment in multiple investee companies. Then this works. Set up a single co-investment vehicle for all co-investments. And if SEBI is of the view that this obstructs the pro rata circular, then SEBI can consider allowing one co-investment vehicle per co-investment with no restrictions as to the number of CIVs that could co-invest alongside the main AIF. So this is exactly what they are also saying, that no restriction on how many CIVs I can launch. Tomorrow I can launch 100 also if I want to do 100 co-investments. No separate sponsor commitment should be required for CIV since the sponsor would have made its commitment to the main AIF. This is very helpful. What if the sponsor actually doesn't want to do the co-investment? If you have sponsor commitment requirement in co-investment, then that could really change the current structure as well. Because remember, in PMS, manager doesn't have skin in the game requirements. Skin in the game requirements are only in the AIF regulations. So manager in a PMS is not actually investing in the companies where he's advising you to invest or where he's making your investments. AIFs have that. So currently also in co-investment, manager or a sponsor are not actually investing in the co-investment companies in the current framework. So why have it in the new one? I think don't have the sponsor commitment restriction. And last, minimum tenure of 3 years to not be applicable to a co-investment vehicle. So no minimum tenure restrictions. Let's see what SEBI's views are. So co-investment through a separate co-investment vehicle. The issues, pooling of funds is an essential characteristic of an AIF where the rights of the investors in investments and distributions are pro rata to their commitment in the scheme. To maintain the said characteristic of pooled investment vehicle, any co-investment is currently not allowed within the AIF structure and is facilitated through the PMS structure. SEBI is giving some background here. And in view of the recommendations of the working group, the issues pertaining to maintaining pro rata rights of investors may be addressed by allowing the AIFs to launch a separate co-investment scheme for each co-investment, a co-investment vehicle for each co-investment. So this is very good. SEBI wants to allow separate co-investment vehicles for each co-investment and relax the investment concentration norm. So 100% of the investable funds of one scheme can be in one investee company. So they've accepted Point number 1 and point number 2. Then this would also address the issues being faced by the AIF industry with respect to obtaining additional SEBI registration as a portfolio manager with respect to multiple shareholders in the cap table of the investee company. So currently, because it's a PMS structure, in the cap table of the investee company, each co-investor would individually feature. So each co-investor would come on the cap table then. Here, because a vehicle is making the investment, on the cap table of the investee company, there will be only one investor, which is a co-investment vehicle, and all the co-investors who have agreed to invest in that would be beneficiaries of the co-investment vehicle. They would not feature on the cap table of the investee company. This can also actually help the investee company to maintain confidentiality of who the co-investors are, and investors may also like that because they are getting to maintain confidentiality of their co-investments. There is also a view that the issue pertaining to investee company having to deal with multiple investors may be addressed by executing power of attorney by the co-investors that may empower the co-investment portfolio manager to take all the decisions on behalf of the co-investors in the investee company. However, operational efficiency and effectiveness of the same is not known. So power of attorney just helps smooth the operational process where you have to get the investor to sign off on certain things. However, I really doubt institutional investors will give a power of attorney to the investment manager. But SEBI has suggested this, that they can allow this also. Helpful. A lot of investors who agree with this may just execute a power of attorney, and then the co-investment portfolio manager or the AIF manager will only undertake all the decisions on their behalf, such as voting, administrative procedures, etc. This is a good suggestion. 10.5. Taking into account the suggestions of the working group and internal deliberations, it is proposed to allow managers of the AIF to offer co-investment opportunities with the following conditions. So now here in 10.5, we are seeing what SEBI is allowing. Now this is what SEBI is proposing. This is super important now. First, they are saying that co-investment vehicle shall be a scheme of the AIF category 1 and 2, which shall facilitate co-investment of investors of any of the schemes of the AIF in unlisted securities of investee companies. So they'll have a separate scheme of the same AIF. This is actually good because if you do a new AIF, which is what the working group proposed, right? They said that you do a co-investment vehicles to be registered as a category 1 and 2 AIF. Now the thing is, if you want to launch a new category 1 and 2 AIF, the cost is 1 lakh rupees at the time of making the application and 10 lakh rupees plus GST at the time of getting the registration. So might as well you get the co-investment portfolio manager thing because you are not saving on cost here. But SEBI has actually accepted a better approach, which is that the co-investment vehicle shall be a scheme of the AIF, and the cost to launch a new scheme is 1 lakh rupees plus GST. So this really reduces cost in a big way, and they shall facilitate investment in unlisted securities of investee companies. Point 2, a shelf PPM shall be filed with SEBI at the time of registration if the AIF intends to provide co-investment facility to its investors. Existing AIFs can also file the shelf PPM with SEBI for this purpose. So this is good. They accepted the shelf PPM point, and you have to file this at the time of registration. The format, or if SEBI wants us to follow the current AI format of the shelf PPM, is something that remains to be seen, because if that is there, then there is a significant legal cost that could be incurred by the AIF managers. A separate co-investment scheme shall be launched for each co-investment in an investee company under intimation to SEBI. So you can intimate SEBI and launch a new scheme. This is very similar to what an angel fund does when they launch a new scheme. So I think they're following a similar structure here in accordance with the shelf PPM. So the schemes will be in accordance with the shelf PPM, and each co-investment scheme shall have a separate bank account, demat account and PAN. This is a very big compliance requirement because for each scheme you have to maintain separate bank account, demat account and PAN, which would mean that for each scheme you would have to have a custodian, an agreement with a custodian. This is something that could add costs, but I still think it may be cheaper than a PMS registration cost itself, and custodian anyway would need a PMS also. So this is the structure that they are suggesting. Co-investment through the co-investment scheme shall be offered only to accredited investors. I think they should consider revising this and make it available to all investors. Currently they are proposing only accredited investors. Co-investment scheme shall be exempted from the following requirements. So no investment diversification norms, no sponsor commitment, no minimum tenure. So what all were they asking for? They were asking for 4 things: no diversification norms, no separate commitment, no minimum tenure, and point 2 was already accepted, that you can launch a single CIV for all co-investments, or no restriction on the number of CIVs, co-investment vehicles. So they accepted that also. I think separate co-investment scheme for each. They're not allowing single co-investment scheme for all co-investment vehicle. So not a single CIV for all co-investments, separate only. So point 2 actually has not been accepted completely. Point 2 here is not accepted completely. Next, the co-investment scheme shall be subject to the implementation standards formulated by the standard setting forum of AIF to ensure that the investments by the CIV scheme are made for bona fide purposes and the flexibility extended in this regard is not misused. So we await the implementation standards by the standard setting forum. This is actually the third time SEBI has come up with implementation standards by the standard setting forum. And I think as we go ahead, the standard setting forum is really going to play a big role because SEBI is looking at them very significantly to bring about change in the industry and to come up with implementation standards. They've already done it for pro rata pari passu rights, they did for differential rights. So again for co-investment vehicle also we'll see what they come up with, and this is an interesting update. Next, reviewing conditions of co-terminus exit. So SEBI actually wants to review whether the exit, the terms of the co-investment by the scheme of the AIF and the co-investment vehicle should be identical, including the time of exit. So they are asking if should be identical or not. Currently, it is felt that this should be identical to mitigate conflict of interest between the manager, investors of the AIF and co-investors. Therefore, the current structure is there. AIF industry in the past has also advocated for control over the exit of the co-investor to protect the interests of the investor of the AIF as a rationale in support of the request to allow co-investment within the AIF structure by issuing separate class of units. So when they did separate class of units, they said that we will have entry exits at the same time. That is why we're doing a separate class of units. So working group has also actually recommended that the tenure of the co-investment vehicle to be co-terminus to the main AIF. So with this proposal 4 in the consultation paper, you can think of this being like a referendum from SEBI, where they're asking the industry, what do you want? What do you think? Do you think that having a co-investment vehicle which is not co-terminus is okay? Do you think that is not violating the conflict of interest norms, or what are your views on it? So I would strongly advise all industry participants who are seeing this video, respond to SEBI and suggest your views on what you think on this. I think I go with what the working group is saying, that you should have the tenure of the co-investment vehicle be co-terminus with the main AIF, because that actually avoids conflict of interest. So I am with that view, but would love to know what your views are. Feel free to comment in this video as well what your views are. Next, relaxing the conditions attached to advisory services. So at the start of the video we discussed that currently AIF managers are not allowed to advise on listed investments. So here SEBI has made reference to regulation 20 sub-regulation 15 of the AIF Regulations, which states that the manager shall not provide advisory services to any investor other than the clients of the co-investment portfolio manager specified in the PMS regulations for investment in securities of investee companies where the manager makes an investment. So you can't offer advisory services to any investor other than your clients of co-investment portfolio manager. You can't go and do investment advice separately. You can't offer advice on anything else other than investment in securities of investee companies where the manager makes the investment. The phrase for investment in securities of investee companies where the AIF managed by it makes investment does not differentiate between listed and unlisted securities. Hence, the managers of AIFs presently cannot provide advisory services to investors other than co-investors on listed securities where the AIF managed by it has made investment. So right now they are not able to give advisory services on listed securities. Working group highlighted that the current regime restricts advising on listed securities in co-investment context or to advise on co-investment opportunities in portfolio of other AIFs. So the parallel structure and listed, both of them they're not able to do, and this poses operational and compliance challenges. They recommended to allow managers to do this. Upon internal deliberation, what SEBI is now suggesting is that there may not be similar concerns of conflict of interest between manager and investors of the AIF in providing advisory services on listed securities to investors, irrespective of their AIF having invested in such listed securities or not. So this is actually a very interesting update, because currently if I want to advise on listed securities, I would need a separate investment advice license. SEBI is now saying even if your AIF is not invested in such listed securities, you should be allowed to provide advisory services on listed securities. The investment in listed securities can be bought and sold by the AIF for investors at the prevailing market price. So they can do it at the market price also. However, there may be conflict of interest concerns similar to those in investment in unlisted securities in allowing managers. So just like we have the conflict of interest considerations in unlisted securities, there would be similar conflict of interest situations here if they provide advisory services on listed securities which are thinly traded or not traded. So thinly traded and not traded is an issue, and in this case their AIFs have invested in if their AIFs have invested in such listed securities. So it's a fair thing, because if it's a thinly traded or not traded listed security, then this would be very similar to an unlisted security. Hence, they have conflict of interest considerations. So SEBI is saying that in respect of investment in listed securities of investee companies, manager of the AIF may provide advisory to any investors, irrespective of whether the AIF managed by it has made investment in such listed securities or not. This is the proposal. Do you agree that there are no conflict of interest concerns in allowing managers to provide advisory services on listed securities, irrespective of whether the AIFs managed by them have made investments in such listed securities or not? And do you agree with the view that there may be conflict of interest concerns similar to those in unlisted securities in allowing managers to provide advisory services on listed securities that are thinly traded or not traded? So do let SEBI know your views. The deadline is 30th May. And do let me know your views on this consultation paper. Would love to discuss with anybody who has certain insights on this. Thank you so much for watching.